Hello, and welcome to this presentation on the CARES Act of 2020. I am Cathy Mozingo, and I'm a tax partner at Aldridge Board & Company in Montgomery, Alabama. Today, I'm going to present a brief overview of the income tax provisions of the CARES Act. The Coronavirus Aid, Relief, and Economic Security Act was passed in March of 2020. This $2 trillion stimulus package was enacted to help revive the economy by providing tax relief to businesses and individuals. I will begin by discussing the business income tax provisions. One of the best-known provisions of the CARES Act is the Employee Retention Credit. This is a refundable credit designed to encourage businesses to retain their employees during the COVID-19 crisis. The credit is available to businesses including nonprofits whose operations have been fully or partially suspended as a result of government orders that limit commerce, travel, or group meetings. In general, the credit is 50% of qualified wages. It should be noted that this credit is not available to employers who received a PPP loan. The CARES Act allows employers and self-employed individuals to defer payment of the employer portion of Social Security taxes. This provision is available through the end of 2020. The deferred taxes are paid over 2 years. One half of the deferral is due on December 31, 2021, and the other half is due on December 31 of 2022. Under the old law, corporations were only allowed to deduct charitable contributions to the extent they did not exceed 10% of modified taxable income. The CARES Act expands this limitation and allows corporations to deduct charitable contributions up to 25% of taxable income. The CARES Act relaxes the rules pertaining to net operating losses by temporarily removing the 80% limitation imposed by the Tax Cuts and Jobs Act. Now businesses can use 100% of their losses to offset income in other years. Additionally, businesses may now carry back the losses 5 years. The new rules apply to losses incurred during the 2018, 2019, and 2020 tax years. Employers may now contribute up to $5,250 per year to an employee's qualified student loan. The payment is not taxable to the employee, and it is deductible by the employer. This provision expires at the end of 2020. The Tax Cuts and Jobs Act instituted several limitations on businesses' ability to deduct interest expense. The CARES Act relaxes those limitations by allowing interest expense deduction for up to 50% of adjusted taxable income. This provision is retroactive to 2019 and expires at the end of 2020. For corporations that have been subject to the alternative minimum tax and have remaining AMT credits, the CARES Act accelerates the use of those refundable credits by allowing corporations to claim the credits in 2018 and 2019. Now let's look at the individual tax provisions. The CARES Act made 3 major changes with respect to qualified retirement plans. First, it waives the 10% early withdrawal penalty for distributions of up to $100,000. To qualify for the penalty-free distribution, the account owner must certify that he or she, a spouse or a dependent, has been diagnosed with the coronavirus. This provision is retroactive to January 1, 2020. It should be noted that even though the coronavirus-related distribution is not subject to the 10% premature distribution penalty, the withdrawal is subject to income tax. However, the tax on this distribution may be paid over 3 years. Alternatively, the account owner has 3 years to roll back the money into the retirement account. Second, for individuals who are required to take required minimum distributions from their retirement accounts, the CARES Act eliminates that requirement for 2020. Finally, the CARES Act temporarily increases the amount that an individual may borrow from a qualified employer retirement plan. The loan limit is increased from $50,000 to $100,000. Additionally, the repayment period for these loans is extended. For a more in-depth discussion on potential planning opportunities involving IRAs, please see my colleague Jason Westberg's presentation on IRAs, required minimum distributions, and qualified charitable distributions. The CARES Act made 2 changes with regards to charitable contributions for individuals. For individuals who do not itemize, the new law allows them to deduct up to $300 in charitable contributions. Under the prior law, individuals could only deduct contributions to public charities to the extent that the contributions did not exceed 60% of the taxpayer's adjusted gross income. The CARES Act removes the 60% limitation and allows taxpayers to deduct charitable contributions up to 100% of their adjusted gross income. The CARES Act expands the definition of qualified medical expenses to include over-the-counter medications. This means taxpayers may now use their health savings accounts or their flexible spending accounts to pay for over-the-counter medications such as pain relievers and allergy medication. Alternatively, they may claim the expenses on Schedule A if they itemize. The Tax Cuts and Jobs Act introduced the concept of excess business losses. In essence, the old law limited a taxpayer's ability to deduct excess business losses. An excess business loss is the amount by which total deductions attributable to all trades or businesses exceed total gross income from those businesses, plus $250,000 for individuals or $500,000 for joint returns. The CARES Act eliminates the disallowance for excess business losses for tax years beginning in 2018, 2019, and 2020. As a final note, it is important to remember that all of the above tax provisions refer to federal law. Some states may not conform to federal law, some states may. Therefore, if you plan to take advantage of any of the above provisions, it is important to know if your particular state conforms to the federal tax law. I hope this summary of the CARES Act has been helpful to you. If you would like to take a deeper dive and understand how any of these provisions can impact your specific tax situation, please contact me or one of my partners and we will be happy to assist you.